Hey, everybody, welcome back to this episode with the Growth Factor. On here with myself, Ty Lasater, founding partner and CEO of Lasater Capital, and also, as always, Brian Robb, our managing director here at Lasater Capital, bringing a wealth of experience and knowledge throughout the financial aspect in the financial space. We're going to be talking about today, we're going to compare. We get a bunch of questions as it pertains to investing in real estate that are, should I be passive or should I be an active investor? There's some differentiators there, and there's pros and cons to both. I myself am both, and many of our investors are both. And then we also get a lot of questions. Are you guys a REIT or compare yourself to a REIT? So we're going to go into and talk a little bit, what's the difference between a REIT and direct private placement? And then within direct private placement, you can have direct placement and an active investor, or you can have direct private placement as a passive investor as well. And so we'll get into some of those topics, the pros and cons with each of those and what that looks like. So, Brian, I know you get many of these questions from really back in your more diversified financial days where you were working with stocks, bonds, mutual funds, direct private placements, and things like that, and now coming into the real estate space. I know from talking to investors, you're going to get kind of a gamut of the questions, and so why don't you kind of lead us through some of the questions that you typically get, both as a financial advisor and or as a representative of a private offering or a private placement.
Yeah, thanks, Ty. I actually just had this question come up yesterday because I think the natural progression for a lot of investors is who want to get exposure to real estate is they're going to start with the REIT. Like that's going to be my go-to. I'm going to start there, get used to it, get some experience with the REIT, and then I might look at other options. That was the call I just had yesterday morning. Investor had about 10 years of experience in REITs, and so the big question was, why would I change? What's different and unique about a direct private placement that I can't get that I've already gotten today? And there's really four or five pretty salient points that I think are worth mentioning. Not necessarily in this order, but certainly a big priority is going to be the tax benefits. And I think that's probably a good place for us to start is looking at what type of benefits do you get, assuming you're in a non-retirement account, what type of benefits do you get in a REIT versus a direct private placement. So might be good to touch on that. Why don't I
Yeah,
turn it over to you to talk private placements and we can both talk a little bit about REITs.
absolutely. And before we do, I'm just noticing, so it's past No Shave November, but I grew out my beard for a ski trip, and now I'm looking in the camera and seeing the amount of gray in it. So I don't know if that is from real estate and the headaches that comes with it and managing your own real estate, or if it's my three kids that are constantly causing some sort of an issue that I have to deal with. But that being said, people look at real estate because of number one, the tax benefits that it brings you. That's one of the biggest aspects. You can generate a return on your capital while also having tax efficiency, and along the way, while owning real estate, having some losses to offset some of the income and some of the distributions that you have along the way. And so when you invest in a REIT, you're not going to get those tax advantages. I've talked about this before. In fact, I was talking about this on a radio show this morning. That with a REIT, you're indirectly investing in real estate. And what I mean by that is you're investing in a company just like a stock. So it's no different than, let's say you invest in Walmart. When you invest in Walmart, you're not investing in the toothpaste that they carry on their shelf, and you're not investing in the blue jeans that they sell and the outdoor equipment that they sell. You're investing in Walmart, the business. And so with a REIT, you're doing the same thing. You're investing in a company that just so happens to allocate their capital into real estate. And so you're in that format, your money is going to be in the real estate sector, but you're not going to get the benefits of direct ownership. And Congress has built tax code around direct ownership in real estate. That's, here in Texas, that's called fee and simple interest. So you directly own the real estate. With a REIT, you do not directly own the real estate. And so you're not getting those tax advantages. I think with a REIT, you're going to be limited to qualified business income and what that tax rate is at. However, with direct placement in real estate, when you directly own real estate, you're going to get the advantages of depreciation. Okay. And so what we use a segregation study. So when we buy a specific property, let's say we're buying a $10 million, small $10 million multifamily asset. When we purchase that property, roughly 10% of it, or about $1 million, is going to be allocated to the land. Now, that varies location by location, deal by deal. But for simple purposes, let's say 10% of the acquisition is allocated to the land. Obviously, that land is not depreciable. The other 90%, or $9 million, is depreciable. Standard straight line, standard depreciation is going to say that I can depreciate real estate over a 27.5 year period. Okay. So you equally divide up that $9 million by 27.5 years and you depreciate it over that time period. Okay. Well, you're not going to have many losses in that circumstance. However, there's unique opportunities with real estate, and especially with Trump's big, beautiful bill that extended those tax benefits. We get aggressive and accelerated depreciation on the front end, whereby we can depreciate about 70% of the depreciable asset in the first year, and then the remaining 30% over the next 5 to 7 years. And so we're going to have a huge loss in year one. So let's say year one, we bought this $10 million asset. The $10 million asset produces, let's say, $1.5 million in revenue, and it produces $400,000 of net operating income after expenses in year one. And we're going to come in and we're going to do our value add, renovate units, and start increasing rent and hopefully decreasing some of the operating expenses. So NOI is going to go up. Okay, so we're going to have $400,000, let's say, of distributable cash flow in the first year. Well, we're going to have, of the $9 million, we're going to have about $6.5 million of depreciation expense in that first year. So not only are we not going to have $400,000 of reportable income, we're now going to have about $6 million of losses that we can take and distribute to each of the investors in that asset. And so that $6 million then is in the circumstance where an investor may be a full-time real estate professional themselves, they can use some of that loss against other income that they have. If they're not a full-time real estate investor, they can utilize that loss on any other passive investments, I'll say, that they have. And then once they've utilized all that loss against any passive investments that they have, they can carry that loss forward to the following year and the following year and the following year until they eat into all of it. And then they're going to have some depreciation recapture on the back end. However, with the asset itself that we've depreciated down, we have a new adjusted basis when we go to sell it. And so there's going to be a little bit of loss left over in the final year. We're going to adjust the basis. We're going to sell the asset. So the net tax effect on that investment is going to be zero for the years that we held it. And then in the year that we exit, it's going to be somewhere in the range of 14 to 16%. And so there's huge tax benefits in the direct placement. Whereas with a REIT, you're not going to get those pass-through expenses as a direct owner. You're holding a share of a stock. So any distributions that you get is going to be reported, and you're going to pay the equivalent tax on that. When they sell the assets, you're not getting a capital. You're not getting a capital gain that has the ability for an adjusted basis because you're holding a stock. You're holding a stock that ultimately holds a real estate placement, and so you're not going to get those significant tax advantages that you get that come with real estate when you're in a REIT.
Yeah, I mean, a lot of advantages there. Not a lot of people know this, but REITs, by very definition or by law, have to distribute 90% of their income out. So the other question that I get a lot is, what's the growth potential? I've been doing pretty good. My REIT over the past, it's had some bumps along the way, which is pretty normal. But over time, they advertise a 5 or 10% return, something like that. But REITs, because they have to pass out a majority of their income, is primarily an income play, right? Can you tell us a little bit about growth potential of a direct private placement compared to a REIT?
Yeah, with a REIT, REITs are looking for big, beautiful buildings that are not going to have much appreciation to them. They're not going to have a big value add play to them. They're cash flowing the day they purchase it. They typically use low leverage, and so it'll cash flow a little bit along the way. Like you said, 90% of those, 90% of the income has to be distributed. So back to my example, if a REIT bought that same $10 million asset that produced $400,000 of NOI that's distributed, that $400,000 is distributed. There's no offsetting tax advantages to it, and you're paying your equivalent tax rate. I'm sure most of our listeners are in the 36% rough tax bracket. So you're paying roughly 36% tax on that distribution. And with very little to no growth upside on that investment. With direct placements, typically the allocators, the manager is not deploying the same size dollar figures that a REIT is. If you look at most of the REITs, they're going to be large nine-figure REITs, 500 million to $5 billion REITs and larger sometimes. So they've got to allocate their capital across so many assets, whereas an operator that's got a direct private placement is deploying anywhere from 4 million to maybe 100 million or up as high as a billion in some circumstances. And so in that aspect, those direct operators have a lot stronger grasp on the micro focus of an investment. And they're going to be looking for investments that have a value add play that they can step in day one and implement a value add strategy that's going to not only increase the cash flow along the ways, but it's also going to significantly increase the value of the asset for an exit potential in 3 to 7, sometimes 10 years, kind of depending on the hold. And so with a direct placement, you're looking, so let's go back to that $10 million example where we bought a $10 million asset. That $10 million asset, when we look at it and we say, okay, it's generating a million and a half in revenue. But I know based on the location that it's at and based on the prior ownership, they've owned it for a decade. They haven't focused on market rate rents. I know that market rate rent would push us closer to $1.9 million in revenue. Well, my value add play is going to be stepping in and accomplishing that $1.9 million revenue as fast as possible. By going from 1.5 to 1.9, that alone adds $400,000 to NOI. So our NOI number goes from 400,000 to 800,000 just from increasing revenue. Okay. And so that then also plays into the valuation of the property. If the property is trading on a 6 cap, you're adding $400,000 of NOI at a 6 cap. So if you do the math on that, let's see, 400,000 by 0.06, that's adding roughly $7 million of value just in day one. Okay, so now that $10 million purchase goes to about a $17 million value just by increasing the rent. And that's REITs are not looking for that. They're looking to buy an asset that's already cash flowing, it's already at market rate. They just want to buy and hold it. And it's almost like a higher yielding CD. It has a little bit higher risk than a CD. So in turn, it has a little bit more cash flow than a CD does, but not a whole bunch of upside potential. Whereas with direct placements, you're looking, our focus is to double our money in roughly 5 to 7 years. I want to double our money. And so you're not going to get that kind of growth potential in a REIT because they don't have the ability to force that value add like you do in a direct private placement.
No, it's a great point. We've talked about this on prior episodes where we are really able to capture the inefficiencies of these local markets where a 5, 20, $50 billion REIT is really going to be looking primarily at efficiently priced properties out there. And so, being able to find the value adds is going to be really, really difficult when you've got that much capital to deploy. A loose analogy I would kind of think about is if you think about the broader equity markets, small caps over time have outperformed large caps. We're kind of a small cap because we can take advantage of some of those inefficiencies in those local markets, and the big, huge REITs are more like they're going to act more like large cap stocks. So I think that's probably a good correlation to bring between the two. And speaking of correlation, this was another question I got yesterday regarding the broader markets and the need really to diversify. That's a good question to ask. Am I diversified? We've talked about this before. Are bonds a good way to diversify against equity? What about precious metals? And the question that came up yesterday was, well, what about real estate? Can't I get some diversification from any bumps in the market through a REIT? And I think the question to think about there is when you look at correlation to the broader markets, REITs are typically going to track very closely. I think over time it's going to be 60 to 80%, let's say 75% on average. So if the equity markets are moving, REITs are typically going to move along with that, and vice versa when we see volatility on the downside. Ty, can you tell us a little bit about the asymmetric risk profile or the counter correlating properties of direct private placements?
Yeah. So like you said, let's start with the REIT side. The REIT is going to track typically the equities market. You've got publicly traded REITs, and then you've got some private traded REITs as well. But they're gonna function very similar to the equities market. And with direct placement, you've got little to no correlation at all to the equities market. Now, what we're seeing right now in today's environment is interest rates. Interest rates have an impact both in private real estate as well as the equities market, just because that's where both companies and real estate investors are going to borrow from their leverage perspective, but it still does not create a correlation between the two. And so with private placement real estate, at the end of the day, let's focus on multifamily or housing, single family, multifamily, or RV parks, mobile home parks, anything that's providing housing right now. We're seeing a big jump in. So back in the late 90s, early 2000s, we started seeing some a jump in mobile home parks. And they were becoming more and more not what you think of across the Midwest, but more of like a retirement community in Florida. And we started seeing these mobile home parks pop up around small golf communities. They would put in a concrete pad, and then you put your mobile home goes on a concrete pad. Where traditionally across the Midwest, we would see mobile home parks, and it was out on dirt. You've got 150 mobile homes just lined up on dirt, and typically not great living conditions. Now you're seeing better and better living conditions, and what we're seeing now is housing is becoming more and more unaffordable. Is we're seeing more and more of these pop up, and
Yeah.
so taking any aspect of the housing space, whether it's a mobile home park, an RV park, a multifamily, or a single family, you have zero correlation to the equities market because at the end of the day, 70% roughly of America they rent their home, or they don't directly own their home, and they have to have a place to lay their head. Now, there may be an impact of the equities market and the greater economy because of inflation as to what rent rates are. However, it does not impact the valuation of real estate and housing as a whole. And so which I think we are looking at a market correction. We're looking at an equities market correction. I think we're not going to see that until we see interest rates come down to where we think they're sustainable. I think that number is going to fall somewhere between 5.5 and 5.9. Whether that is Powell with everything that's going on now, or that's the new Fed chair that comes in May, or if it's before, then before. I think we're going to need to see probably two or three more rate cuts that equate to 75 basis points to 100 basis points. And then I think we're going to see slowly those interest rates track into borrowing from whether you're an individual home buyer or you're a real estate developer that's borrowing and those rates taking effect. And once they do, then we're going to start seeing money moving out of the equities market and back into fixed assets like real estate. And when that happens, we're going to see a market correction. And we're going to see where the S&P is trading at, 4x plus book value right now. We're going to see that come back down to a more reasonable multiple of book value, maybe closer to 2.5x of book value. We're going to see a market correction. We're going to see more capital deployed into real estate. But as you look at that, that is not going to necessarily positively or negatively impact the real estate market. The equities market takes a dive. Real estate market is not going to take a big jump or a dive because of it. It's going to be focused more around supply and demand of real estate. And right now, demand outpaces supply for affordable housing by more than 30%. And developers are not developing, builders are not building right now because of the cost of debt. So absolutely zero correlation to what the equities market does. At the end of the day, we've got too many people needing housing, more people needing housing right now than available housing. Like I'm seeing a thing right now, a big trend in some of our top 10 major markets where you've got it's very similar to college housing. You've got roommates coming in and renting by the room instead of renting the house. And so I know some smaller real estate investors that own, 100, 200 to 500 single family homes that are leasing out to four separate tenants in a four-bedroom house instead of leasing to one tenant that has a family. And so that is purely a byproduct, and they're getting three times what they used to get in rent when they would rent it out to one single family. That is a byproduct of the inaffordability and the lack of supply of real estate.
Yeah, even in some of these major markets, Austin, Dallas, I mean, we're still seeing building, but we're seeing new supply start to slow significantly. I think I read even in Austin next year or this year, it's projected to be something like 5 or 6%, when historically it's been double that, Ty. So you're seeing that even in high growth markets like we have in Texas.
Yeah.
So let's talk about something that should be important for every investor, and that is manager incentives and alignment. Most people would want to work with a manager or an operator that's sitting on the same side of the table with them and not across the table from them. And so I think it's good to look at where do the alignment and the incentives fall for these various structures. And with a REIT, really any fund structure, they're going to have a management fee. They're going to have certain costs that are involved. That's going to get paid regardless, right? You might be paying a 50 basis point fee or 150 basis point fee, depending on the share class. So you're always going to have that fee regardless of performance. Can you talk to us a little bit about manager incentives on a direct private placement, which touches a little bit about the waterfall structure?
Yeah, so I think you just brought it up. So with direct private placements, they're going to mirror very much like traditional private equity, where there's direct alignment. And in our instance, myself and Boone, my brother and business partner, invest directly in each of our funds. So we have capital that we've invested our own money directly into the fund, no different than any other investor that comes in. And that money, our money that's invested in the fund, is treated the exact same way as every other investor. But then we have the management side. And so you brought up a waterfall. There's a waterfall structure in direct private placements. So we've got our money deployed, but then there's typically, like in our instance, I'll use a broad example, an 80-20 split. Investors have, for simple purposes, 80% ownership of the assets, and then we have 20% ownership of the assets and or distributions. Now that comes after meeting a certain what's called a hurdle rate or preferred rate of return. Now that preferred rate of return is a flat stated rate that each investor is owed before we as the manager get to participate in any of the upside income on the asset. So for simple purposes, I'll lay one out that doesn't have multiple. Our current fund has multiple levels depending on what level you come in and invest at. We've got about 750 investors, and north of 10% of that have well north of $1 million invested with us. And then we've got another roughly 60% has north of a $500,000, but less than $1.5 million invested with us. And then the rest are somewhere between 100,000 and a $500,000. And so we've set up different classes depending on the size that you come in at. But let's forget about that and we'll use one class as an example. So what we would typically do is we set up a fund that we're going to bring capital into, and the investor earns an 8% preferred rate of return per year before the waterfall takes effect. And so the way that works out is, let's say, and the preferred return or the hurdle rate has nothing to do with cash flow from an asset. Typically, when we buy an asset that's a value add asset, the first year plus or minus is going to have little to no cash flow because we're, taking bad tenants out, we're increasing rent, we're renovating units, we're going to have some vacancy that we experience during that time. And we've talked about this before where if you revalued the asset within the first 24 months after purchasing it, it's going to have a lower value than what it did when we purchased it. And we utilize that opportunity when we've got investors that are doing our Roth conversion strategy that we talk about. But that being said, let's say we've finished the value add and now we're leasing it back up and we start seeing cash flow. So, you may have zero cash flow year one, you may have 2% in year two, you may have 8% in year three. That has nothing to do with the hurdle rate or the preferred return. The hurdle rate is set and it says, as an operator, I'm buying assets that I know I can meet 8% per year, at least through the exit. And I can beat that so that I can then participate in some sort of profit splits. And so let's say in year one, there was zero cash flow. So an investor is going to accrue their 8% preferred return into year two. At the end of year two, let's say there was 2% cash flow that was distributed to the investors. By the end of year two, they've earned another 8%. So they're owed 16% on their money. And they were just paid in year two, 2%. So now net, they're owed 14% going into year three. And let's say year three paid out 8%. It met the preferred return. Okay, so now they carry in, they're still there at 14% going into year four. Let's say year four was 10% distribution, covered the 8%, and it knocked off an additional 2% that they had carried over. So now going into year five, they're still owed 12% from year one and what's left of year two. And then we sell the asset in year five. When we sell the asset, first money goes to catch up the remaining 12% preferred return that's due. Then we pay back the investor's capital. And then everything that's left over and above that is split 80% to the investor, 20% to us. And so in order for us to make a payday and to see the fruits of our labor, we have to be able to execute on the business plan and exit profitably over and above 8% per year on the asset in order for us to get paid. So we are very much aligned in what the exit is of the assets. Whereas with a REIT, they're going to get, typically it's a much higher fee structure. They're going to get their management fee. They're going to get a number of fees and or expenses. They're going to have expenses that cover their costs along the way that they're going to get whether the asset performs or not. And so, the asset may be a complete loss and they're still going to have executed and received their fees along the way. So it's no different than a stock, holding a stock in that example.
Yeah, it's interesting, Ty. Some of the large REITs that are out there, they will purchase properties and they will get management fees off the actual fund, but then also operate the underlying entities as portfolio companies and get carry on the back end. So you're actually benefiting on the fund, on the REIT fund, as well as an incentive on the carry on the back end as well. And so that kind of lends itself to one of our final points, and that's just overall transparency, which I think is good for us to touch on. When you look at a lot of these REITs that are out there, let me back up. When you look at a lot of publicly traded mutual funds that are out there, the accounting that goes into calculating the net asset value is pretty clear, right? You look at the total market cap, outstanding shares, you can back into the math and really identify that. For REIT funds, it's a little different. A lot of times the NAV is actually determined by the provider itself. And so I was looking at one of the larger REITs, and in 2025, it shows operating losses for every month of the year. Interest rate expense, not uncommon, right? We've seen interest rate expense have an impact on the industry, but operating losses for all 12 months of 2025. But at the same time, it's showing positive performance for all 12 months of 2025. So it's interesting when you look from a transparency standpoint, you really have to dig into the prospectus and understand the underlying metrics and the underlying financials, and probably utilize that as probably a better gauge on the health of the overall fund, and or how specifically is the NAV calculated in these cases. So there can be a lot of discrepancy and a lot of variation across the industry on how that works.
Yeah, I think when you've got and that goes into factor as well on private placement. But where a private placement differs is the value add aspect that they're going to have on that asset. Whereas, with a REIT, they're buying something that's in place as is, and they're looking to just hold that long term. So they may be functioning with NOLs, net operating losses, indefinitely, and then showing that the value of that asset is twice as what it really may be. Whereas with a private placement, for us, we're valuing our assets based on NOI once we've stabilized that asset. So once we have gone in and done the value add phase to the property, we'll hold it at book value. We'll hold it at, cost basis for the first, I think it's 24 months. So for the first 2 years after we purchase the property, we hold it at cost basis. And then once we've implemented the business strategy, we start holding it and valuing it based on an NOI multiple. So whatever the cap rate is on that asset in that market at that given time, we're applying that cap rate to the NOI at that time and valuing the asset accordingly. Whereas in a REIT circumstance, they're not necessarily doing it that way. And oftentimes you see examples where a balance sheet is extremely overinflated in instances with many REITs, especially when there's a real estate market correction.
Absolutely. Yeah, probably the last item that we talk about, and that I'm getting some questions on, is liquidity. I like to be able to get access to my money. That's always another question. When you have a 30-year-old that's saving for retirement and is interested in liquidity, you kind of have to wonder, what specifically are they looking for? Is it liquidity for your overall portfolio? Is it just a portion that you're looking to invest? But I think there is this notion that REITs offer full liquidity, and the reality is they are designed to maybe offer more liquidity. Minimums can be a little bit lower, but that doesn't necessarily guarantee liquidity. The past couple of years, we saw, again, some of the larger REITs actually stop distributions altogether, or they put you in a stack. So if you requested a distribution, you went in a queue, maybe 3, 6, 9 months later, you might get a distribution. On earlier episodes, we've talked about the value or the benefit of behavioral finance and the benefit of maybe not being able to go in and make some of those mistakes like buying high and selling low. So there is a benefit to some of that liquidity, but can you touch a little bit more maybe on why we'd look at a DPP versus a REIT from a liquidity standpoint?
Yeah, so I think if you're looking at the four key factors that we've talked about today, we've talked about tax advantages where a direct private placement far outperforms a REIT. Okay, so the tax advantages check to the private placement. Growth and growth potential significantly, private placement significantly outperforms a REIT. A REIT's focus more on cash flow. So alignment is the next one. Alignment is definitely stronger on the direct placement side because of the way the waterfalls and the management incentive programs are structured. And then if you want to throw in, we can throw in cash flow. Cash flow, with a REIT, they're required to distribute 90% of their income. With a private placement, they're not required to do that. However, cash flow is going to be pretty similar across both. You may get a couple of basis points, a few basis points higher with a REIT because REIT's buying in-place cash flow, and they're not going to force any vacancy in order to create their value add or things like that. So cash flow maybe right down the middle or slightly to the REIT side. And the last thing is liquidity. If you're just looking at it from a how much capital do I have to place and how liquid is that capital? A REIT is going to check the box there over a direct private placement. Typically with REITs, you're somewhere around $1,000 to $2,500 minimum investment. It's going to give or take depending on the REIT. Whereas with private placements, it's 25, 50, and oftentimes now we're seeing as high as 250,000 minimum investment. There's a lot of operators out there going to that $250,000 minimum investment. And what they're wanting to do is they're wanting to deal with people that understand that this is an illiquid investment. They have the ability to place that illiquid investment. And they're saying that from the beginning. Look, as a direct placement, you are buying real estate along with a number of other partners. And so if you have a crisis and you need liquidity, you're not going to be able to go to that private placement manager and say, hey, I need you to sell the asset right now because I need liquidity. When you invest in a direct private placement, it's a 5 year plus or minus hold. Could be as quick as 2 years, could be as long as 10 years. Okay. And that is a byproduct of directly owning real estate. With a REIT, they say that they're more liquid. You can trade your shares. However, there are times where they turn off redemptions. We saw this in the last 3 years with a number of the large private equity companies where they stopped all redemptions, or they went in and said, okay, redemptions are going to be a 6 month or a 12-month case by case basis. And so that way it prevents a run on the bank, if you will. And it allows the REIT to manage the assets accordingly because they may be in a position where they've been holding an asset on their balance sheet at $50 million and the market says that it's only worth 30 million right now. They're showing that it's still worth 50 million and it's operating with net operating losses and they're not making distributions. And so investors want to take their money out. Well, in that case, they're not going to sell that asset and execute on a final loss. They're going to lock up redemptions. Okay. And so we see that in REITs where, they may be liquid and they're liquid as long as not too many people are making redemption requests. The minute too many people make redemption requests, that liquidity is turned off. Whereas with a direct private placement, it's just from the get-go, that when that asset is sold is when you'll see your liquidity standpoint and not until then.
And this is going to be a portion, right? It's rarely going to be 100%. So liquidity really should be viewed holistically as far as your entire investable portfolio. We're just talking about a portion of it here.
That's exactly right. Yeah. So, you're not gonna allocate 100% of your portfolio into real estate. Now, as a real estate operator, I'm much more heavily weighed that way. I'm 80% at this point in real estate. Some of that is direct ownership, some of that is passive investments. And then I've got my other investments. I've got some that's liquid. I've got some in equities, and I've got some in private businesses as well. But with that, you've got some investors that may have only 10% allocated into real estate. And so, depending on where you are in your career, where you are in your life, in your retirement, and your income producing activities and what those look like, that's going to help determine how much you allocate to illiquid investments like real estate. And a young entrepreneur that's in his 40s that's generating, or even I've got a number of doctors and medical professionals that they earn 400 to 1.2 million dollars a year. They have a high amount of income. They've got to have a place to allocate that. And they're 60, 70, 80% allocated into private investment real estate because they still have a lengthy career in front of them of earning high 6 to low 7 figure incomes. And they have the liquidity to place into illiquid investments and they can live easily on 30, 40, 50% of their income, knowing that they won't have a crisis issue that they're going to have to try to find a way to dip into that illiquid investment in any shape or form. And so it really depends on where you're at in your life on how you allocate that. But knowing that you're not going to allocate everything that you have into direct private placements that have an illiquid factor to them. You're going to allocate a portion of your capital there.
Yeah, great points, Ty. You know, the last thing I was thinking of is we have a number of investors that may work with professional advisors in the marketplace, and they might ask their advisor what options are available. Most advisory firms that I've seen are going to have your standard suite of REITs that are available, right? Because it's somewhat the easy button. You can click a few buttons and make a trade, and it's done. A lot of advisors may not know it's not difficult at all to also sell direct private placements. If you haven't done it before, it's probably a lot easier than you think. And so, if you do currently work with an advisor, we can make that exceptionally simple for them. That should not be a barrier to entry for you.
Yeah, no, not at all. I think you bring up a good point, and I haven't really thought about this before, but we've had a number of professionals that worked with us that are financially licensed, yourself included. And in order to receive your variable compensation, you've got to hang your license through a broker dealer. We are not a broker dealer. And so we partner with a broker dealer that also has an independent, they're an RIA. And so they have a number of independent advisors that work with them that manage I mean, I think they've got 1,800 advisors working under this broker dealer. And those 1,800 advisors are by and large managing equities, stocks, bonds, and mutual funds for their clients. And they have access to our private real estate offerings. And there is absolutely avenues for advisors to work with private offerings like ourselves, and you know all about that, Brian. And we work with a handful of advisors currently that look at their clientele's portfolio as a whole, and they allocate anywhere from, in some circumstances, 3 to 5%, and in some circumstances up to as high as 25 or 30% of a potential client or a prospect client's capital into private placements.
Yeah, great points. Yeah, I think this is a great topic. We probably want to touch on it again, you know, in 6 months or a year because the rules do tend to change from time to time. But any final parting words that you would have for our audience, Ty?
Yeah, no, I mean, I think, some of the biggest thing here is we're seeing more and more of a push towards private placements, especially with
Yeah.
some of the legislation that the Trump administration is passing and trying to pass. And we've talked about this before in the past that my grandparents, some of your parents, through their pension funds had allocation into private placements, and by and large part the way that retirement accounts are done now, that has not happened until this new legislation is being pushed in through our current administration, and it creates a significant opportunity for investors. In fact, we're working with a new investor right now that's rolling over a 401k into a self-directed IRA and ultimately allocating into one of our private placements. So there's a number of unique opportunities, and private placements pass through significant opportunities, both from a growth perspective, potential growth perspective, potential cash flow perspective, and significant tax advantages that, the majority of your 99% of your stocks, bonds, mutual funds, and REITs are not going to offer those types of benefits.
That's great. Well, as usual, for anyone who's interested, you can visit our website, lasatercapital.com. It's got our phone numbers on there. We'd love to have a conversation with you further. If you're currently invested or interested in investing in anything that we've discussed today, we can certainly look at those for you as well. So, Ty, anything else?
Absolutely. No, thanks, Brian. Always a pleasure being on. Look forward to answering any questions that anybody may have. So like Brian said, you can check us out at Lasater Capital. That's Lasater, capital CAPITAL.com. Click the follow button wherever you're watching this right now. Shoot us a message. Look forward to answering any questions that you might have. But thanks again for being on again, Brian. And we will bring to you more insights again next week as it pertains to the market at the given time, and how those insights are impacting real estate and our investments as a whole. So we look forward to talking to you next week.